Well, good evening, everyone, and thank you for joining us. My name is Heather Killen, and I am the Program Coordinator at the King's Volunteer Resource Center. I'd like to begin by acknowledging that we're in Mi'kma'ki, the unceded ancestral territory of the Mi'kmaq people. I also acknowledge the contribution of people of African heritage in Nova Scotia for more than 400 years. We pay tribute to and are grateful to our ancestors who came before us to make sure our history is not forgotten. And now, welcome to Financial Literacy for Nonprofits, presented by the King's Volunteer Resource Center. Tonight, we are thrilled to bring you Norman Gedrin. He is an assistant professor of accounting and taxation at Mount St. Vincent University and the coordinator of the Nonprofit Leadership Program and the Mount Tax Clinic. But before I properly introduce him, I have a few reminders. Please keep your microphones muted throughout the presentation. If you have any questions or comments, please type in the chat. We'll be grabbing the discussion from there. The session will probably go until about 8:30. We'll probably take a short break or maybe about 5 minutes around 8 o'clock. Following the presentation, we will be sending you a survey. Please send it out. Your input is very valuable to us. And now, on behalf of the King's Volunteer Resource Center, welcome to Financial Literacy for Nonprofits. Norman Gedrin, MBA, CPA, has more than 30 years of experience managing the accounting, finances, information technology, human resources, and program development for several charities and nonprofits, as well as for municipal government. He has overseen large one-time cultural events, as well as building and capital projects. And he served on various nonprofit and charity boards. He provides advice and support to charities in the arts, education, environmental, and poverty sectors, and he's a really nice guy. Norman, the floor is yours.
Hi, thank you. Thank you very much. As I'm going to go through them, I'm going to just present what topics I'm going to try to cover tonight as best as I can. Okay. First of all, I want to talk about some important regulations that are significant to all volunteer directors on a board of a nonprofit, some basics of accounting, so some accounting fundamentals, some financial planning, which means budgeting primarily, and also internal controls and some investing guidelines as well for nonprofits. Some important regulations. So the ones I want to cover here are how to retain your nonprofit and charitable status and what to look out for. In other words, the fiduciary responsibility of the directors, including their liability, okay, and the defense that directors can take where directors' liability becomes an issue. And finally, the annual reporting requirements of nonprofits. So first of all, we're going to be talking a lot about this is a very legal section of this presentation. I'm going to be talking about the Income Tax Act because nonprofit organizations and charities are essentially created as a result of the Income Tax Act. They are all a form of corporation in most cases, although there are some smaller ones that are just operating as associations that haven't been incorporated. But they are essentially defined by the Income Tax Act, and most of the rules relating to them are sort of explored in the Income Tax Act. So first of all, we'll say that all charities are nonprofits, but not all nonprofits are charities. So let's just begin with what a nonprofit actually is. So in baseline, it's not a charity. Okay, a standard nonprofit organization. It's organized and operated exclusively for social welfare, civic improvement, pleasure, or recreation, or any other purpose except profit. So, for instance, the Nova Scotia Barristers Society, which represents the lawyers, or the CPAs, they are nonprofits. Okay, although they are professional organizations, as an example. An important or key component of this is no part of the income of a nonprofit is payable to or otherwise available for the personal benefit of any proprietor, member, or shareholder thereof. Okay. Now, there are some exceptions for athletic organizations, but when you're looking at that core statement, it's very important because, for instance, I'll give you an example of a situation I found myself in, which was fairly challenging for this. I was on a board of a nonprofit childcare organization, and the parents who were on the board wanted to refund essentially part of the surplus of the organization back to the parents. So when an organization has more revenues than expenses, it can accumulate a surplus, which becomes part of what we call its net assets. Okay. And essentially, that accumulated surplus belongs to the organization. The parents wanted to essentially pay that out back to the parents because they thought it would be a nice gesture. You're not allowed to do that. That's considered a dividend, and it will have your nonprofit status removed. So this is typical of the types of concerns one has to look for in this. Whether or not a nonprofit is actually providing too many benefits to its members is another consideration. So, for instance, golf courses have gotten into a lot of trouble for that. Because, of course, if the golf course operates in such a way that it is continually reducing the price to its members as a result of its investment income, as an example, and these are historic cases, what goes on is that the nonprofit is seen essentially as existing to provide nothing more than a financial advantage to the membership because they're receiving a golf membership for less than the market price. And so golf courses that were nonprofit in status got into trouble for that as well. So one has to be cautious that you're not just existing for the purpose of providing benefits to your members. Okay, particularly financial ones are the big consideration. So a charity is different than a nonprofit in the sense that it is organized for charitable purposes and it is registered with the Canada Revenue Agency as a charity. The CRA has to approve the registration of a charity, and charity. I'll explain the charitable purposes in just a moment, but it has the ability to issue tax receipts. Which result in the charitable tax credit for people who make donations to that charity. Okay, but it has to be operated exclusively and constituted for the charitable purposes, and those are tightly defined in the Income Tax Act. Again, no part of the income, payable or otherwise available for the personal benefit, sorry, of proprietor, members, shareholders, trustees, or settlers. And more than 50% of the directors, trustees, officers, or like officials have to be dealing at arm's length with each other. So, for instance, a group of family members cannot establish a charity and have all of them be part of the directors, be the directors of the organization. At least half of them have to operate at arm's length, which means they're not related to each other in any way. Okay. Now, this is something that a lot of charities don't do, but should be doing. So, for instance, when you are soliciting people to become directors on the board, a charity should be requesting whether or not the individual has a criminal record related to financial dishonesty, which has not been pardoned, okay, or suspended, or whether they were a director of a charity or amateur athletic association that had its registration revoked in the last 5 years. Those individuals are not eligible to sit on the board of directors of a charity. Okay. But most charities that I've worked with tend to be unaware that these rules exist. The purposes of a charity are defined in the Income Tax Act. So the big ones are relief of poverty, advancement of religion, and advancement of education. But there's also this other category, other purposes beneficial to the community, which involves health, for instance, the arts, environment, welfare of animals, and several other causes that can be attributed to this category of other purposes beneficial to the community. So, for instance, but it's not black and white. It's not like just because you are involved in education, as an example, you'll automatically qualify as a charity for the Canada Revenue Agency. And there are advantages to qualifying as a charity. One, of course, is the ability to accept donations from other charities and foundations and from individuals, okay, because foundations and other charities cannot simply transfer funds to other nonprofits unless they're closely related, okay? So it allows you to receive funding from foundations, from other charities, but also allows you to accept individual donations. For instance, childcare organizations used to be, they used to approve them for charitable status because they were in the category of education. And so there are some charitable nonprofit, some charitable childcare organizations, but now the Canada Revenue Agency is very, very tight on approving that. They generally don't, unless in some way that charity also or that childcare organization also is involved in the advancement of religion. Same thing applied to, for instance, with community radio stations, okay, which had a cultural mandate. They are much tighter on approving those now. So it literally is a question of not only researching what the charitable purposes are, but also where the Canada Revenue Agency's perspective on those purposes is now as their interpretation of what they consider acceptable or not. And information related to that is available from the Canada Revenue Agency, and they tend to be fairly transparent about that if you're interested in establishing a charity or converting your nonprofit to a charity. Charities have disbursement requirements dealing with their the assets or the property, okay? What they refer to as property, which are essentially the assets, so everything, including things like the resources that it has at its disposition, such as cash, investments, buildings, and vehicles, things of the sort. But the disbursements relate to property not used directly in charitable activities. So, for instance, if you're operating a church, as an example, advancement of the religion is its primary charitable purpose. And if the entire space of that church is being used for that reason, there is no concern with regards to disbursement quotas. But let's say that a third of the church is essentially rented out to non or just provided for nonprofit organizations to make use of, or other organizations as they see fit. That may not necessarily be part of the charitable purpose of that church. And therefore, that portion of its property may be considered not directly used for charitable activities. And therefore, they may have to look at watching out for disbursement quotas, which is essentially the amount that's being spent on charitable purposes. I'd like to speak about the fiduciary responsibility of directors, okay? And what this essentially means is that you have a responsibility as a director of a nonprofit organization to ensure that funds are spent in accordance with donors or funders' criteria. That's the first thing, because donors can put restrictions on the funds that they give you, or grantors, such as the province or the municipality, can put restrictions on the funds that they give you. And what a restriction is it is a purpose. In other words, you have to spend it for this reason. So directors have to ensure that the funds are being spent in accordance with the criteria established by the donors or the grantors. And they have also an obligation to ensure that statutory obligations are fulfilled, like payroll deductions being remitted, and also that internal controls, which are the procedures that you put in place, and also sometimes physical devices you put in place to ensure that your assets are protected, and that there are no fraudulent transactions occurring within the organization. So directors are responsible for ensuring these three key things. Okay. I'm going to speak now directly about directors' liability, okay, which is where the Canada Revenue Agency can essentially walk in and charge a volunteer director of a nonprofit or charity for debts owing. So and these are debts owing to essentially the Canada, the Receiver General or the province, as an example. Okay. So first of all, again, we're going to use the word corporation because most nonprofits of any size that have a payroll are incorporated. They may be incorporated as a society, but it's still a corporation. Okay. So the directors are jointly and severally liable. And what that means is that each director on the board is fully liable for the entirety of the debts. Okay. And these are a specific series of debts, not debts owing to vendors, but debts owing to the Canada Revenue Agency for specific purposes, or for instance, the province for specific purposes when we talk about workers' compensation as an example. So each director is fully liable, okay? Where the corporation has failed to deduct or withhold taxes. So this is payroll taxes, okay? Now, lack of knowledge is not a defense against this liability, okay? And this is quite important, okay? And you cannot delegate this responsibility to someone else. So if you have a finance manager, as an example, okay, that's working in your organization, you cannot simply assume that the finance manager is taking care of this on your behalf. You have to take steps as a director on a board, as a volunteer, to essentially get evidence that the remittances are taking place, as we're going to see. Okay. So this also applies to HST. So it applies to taxes withheld for employees. It applies to HST, again, jointly and severally liable. It applies to the Canada Pension Plan, and to employment insurance deductions withheld at the source for employees as well. And it also applies to workers' compensation, but that's at a provincial level generally. Okay. Now, if you're just because it's a nonprofit, it doesn't mean that it's not liable. And there are many different types of corporations, okay? But all corporations are liable. And for instance, there are some corporations that aren't actually registered at joint stocks or federally. They are created by an act of law. So, for instance, the Clean Nova Scotia Foundation has its own act of law that was passed in the Nova Scotia legislature, creating it or incorporating it. So there are a variety of different corporations, but these rules apply to all of them. Okay. Doesn't matter if it's for profit or non-profit. And it doesn't matter if the directors are shareholders earning money for being on the board, or whether they are volunteers on a non-profit organization board. They are liable. Okay. How do you defend against this? Well, it's due diligence. And what that means is this: exercising the degree of care, diligence, and skill to prevent the failure that a reasonably prudent person would have exercised in comparable circumstances. So the reasonable person test is used throughout law, okay? And it's used significantly in the Income Tax Act and all other financial acts of Canada and the province. And that always asks the question, what would a reasonably prudent person do in the circumstances to ensure that the source deductions have been remitted, that there's no liability owing to the receiver general? And same thing with HST. If you're collecting HST as a nonprofit, what would you do to ensure that that is taking place? A reasonably prudent person do. Okay. Now, the degree of responsibility changes depending upon the circumstances of the individual director, and also on the circumstances of the nonprofit. So if you are what's called referred to as an inside director, and what that means is essentially you are directly involved in the financial aspects of the organization. For instance, you're actually doing the bookkeeping of the organization. Your responsibility is higher, okay, versus an outside director, one that is just simply doesn't mean they won't be liable. Wow. I just got thrown out there. Can anyone can anyone hear me?
Hi, Norman. We're good.
I hear you now.
Okay. Just give me a moment here to reestablish my window here. I don't know what happened there. Um, okay. So just to continue, um, so financial difficulties, if you're running out of cash, you need to take additional steps to ensure that you're actually that the remittances are taking place and that there are no debts owing. Just give me a moment here because I've lost my main screen. This is odd.
We can see slide 19.
You can see slide 19? Okay, that's good. All right. I I'm going to have to stare to the right of me here because it's on a different screen and my main screen is no longer projecting after this new start this restart. So I'll have to just stare to the right. So please forgive me. Also, the other consideration is if you have persistent budget deficits, okay, and you are heading towards insolvency, in other words, unable to pay your debts, okay. All right. How do you exercise this defense? Well, you want to require evidence at every board meeting that the remittances are being made, okay? And you need proof that the internal controls are reasonable within the organization to ensure that the amounts that are being actually reported on the balance sheet that are being given to you as board members at a meeting, for instance, are reasonably or materially accurate. Okay. I'm going to talk about those internal controls later on, and the types of proof. I'll get into them a bit later as well. But the evidence has to be presented. And I'll just give you a story from my experience of a situation with a nonprofit radio station here in Halifax, which was made public. And so this is not, I'm not sharing internal stuff. Everyone was made aware of the situation, and it was quite well publicized. Um, what occurred is that the board of directors, who were a group of very well-meaning people, and we have an expression in the French community, toujours les mêmes, which means always the same. These directors also sat on a number of other community organizations because it's very often the same people who do the work for a number of different organizations. And they relied on the executive director's reports, who would just tell them that everything is okay with the Canada Revenue Agency at meetings, but didn't really go into any greater depth than that in terms of what was going on. And essentially, what had happened is that the organization had not made source deduction payments to the Canada Revenue Agency for 3 years. And so they owed over $80,000 in source deductions. And the Canada Revenue Agency started calling these volunteers at home and asking them about the value of their house and their car and things of that sort. And we're advising them that they may be personally liable for the $80,000 owing, although the number had not yet been established at the time. So it was just the amounts owing for the last 3 years source deductions that hadn't been remitted. Essentially, that took a process of determining the amount, and then we negotiated with the Canada Revenue Agency for a delay. They gave us 9 months to repay it. We did a fundraising campaign to raise the funds to pay it off. But one could think about the impact it would have had on the community if, in fact, this wouldn't have been negotiable, because sometimes it's not. And the Canada Revenue Agency would have gone after the individual volunteers for those funds because they did not have a due diligence defense. They did not have any evidence asked for in board meetings that the source deductions were all remitted and on time. It would have had dramatic effect on a number of organizations. It would have frozen the volunteer landscape in our community here in Halifax. Um, it, it would have been horrific, the outcome of that. So it's something that really needs to be watched out for. Okay. The annual reporting requirements, basically for a nonprofit corporation, you have 6 months after the fiscal year end, whatever that may be. It's not necessarily December 31. A lot of the nonprofits have a March 31 year end because they receive government funding, as an example, to file the T2 corporate information return. And if you have, okay, assets more than $200,000, okay, or you have investment income, or they call passive income, rentals, royalties, interest, taxable dividends totaling more than $10,000. You also need to file a T1044 nonprofit organization information return. I just dealt with an organization 2 months ago where I had to file 10 years of tax returns. They weren't aware that they had to submit their T2s and these T1044s. The estimated penalties if Canada Revenue Agency could have applied on this for this organization was roughly in the neighborhood of about $50,000. They can, I believe, it's $2,500 a year for the T1044. So, plus, additional penalties for plus interest, which is compounded, right? So be cautious on these. Every corporation has to file a tax return every year, the T2. And if you have this situation, okay, and it occurs once, then forever on, you need to file a T1044 as well, okay? For a charity, it is the charity information return, and if you don't file it, you lose your charitable status. And this information, incidentally, on a charity, if you're ever wanting to look up a charity, you just go to the charity registry at the Canada Revenue Agency, and you will see all of the data from their charity information filings, except some confidential pieces, such as the address of the directors and things of that sort. But you're going to see that all of the financial information submitted in a return is public information. Okay. So I'm going to speak about some accounting fundamentals now. And just give me a moment here, because I'm not seeing my chat box in case there are any chats either.
No, there's no questions so far.
Is that what you were asking?
Yeah, okay, here. I've just seen it back here.
Yeah.
Okay, good. Just in case. So I'm just going to speak about the different statements that we use that are critical that you receive on a board and some of the accounting fundamentals that support these. Okay. So first of all, you're going to hear this term used a lot, generally accepted accounting principles. And essentially, what these are defined in the CPA handbook. And they are a series of rules and procedures, principles as well, that are applied in determining or in creating financial statements, their format, what should be included, what shouldn't be, how the transactions are treated, okay, and how, for instance, surplus and assets are determined, okay. But it goes beyond the handbook. For instance, some industries have their own additional standards that are unique to them. So if you're in healthcare, for instance, there are a series of additional rules related to healthcare that go beyond what's in that handbook. There are also other sources of information, which include policy statements from CPA Canada and the Public Accounting Board and things of the sort. Not the Public Accounting Board, the Accounting Standards Board. Forgive me. So there are other sources as well. Okay. There are two bases of accounting that can be used with nonprofits. Very small ones can use cash accounting, okay, which is essentially all transactions are recorded when the cash changes hands. But the standard is accrual accounting. And what that means is that when revenues are earned and expenses are incurred, we record a transaction. So, for instance, you receive a bill, as an example, from Nova Scotia Power for the heat, the electricity in a place. You record that expense at the time you receive the bill, even though you may be paying it 30 days later. Okay. But it belongs to the time period of the bill, of the date of the bill. So, in other words, there is a difference in the timing between when the revenues are earned, the expenses are incurred, and when the cash actually changes hands, and it creates a separate set of transactions. And it allows you to be more precise in terms of matching revenues and expenses. And also takes into account obligations that you have incurred, even though you have not necessarily paid for them. So it's a more accurate method of actually tracking the financial situation of an organization at any time. Okay. Now, under accrual accounting for nonprofits, there are two methods. One's called the deferral method, and the other one's called the restricted fund method. Now, the restricted fund method is used for large organizations that have, for instance, endowments and multiple locked restricted funds. So you're looking at hospitals, universities, and so on. Some will use the restricted fund method. It's a very complex accounting method, and it requires a lot of skill to manage and a lot of staff, to be honest. So most nonprofits use the deferral method. Okay. Smaller nonprofits that rely on software like QuickBooks or Sage 50, as an example, the deferral method works quite well. Okay. So, one thing you have to be concerned about, and I mentioned this in the fiduciary duties, is this notion of revenue and fund restrictions. Okay. And this is unique to nonprofit accounting. So, for-profit accounting doesn't consider this in the least. And that's that grantors and donors can assign restrictions, okay, to their contributions, stating how they're going to be used. And also the board can internally restrict funds and say, we have these surpluses, this is what they're going to be used for. Okay. So amounts that are received can sometimes be considered a liability, in other words, a debt, until they are actually spent. So an example of this is if you receive a grant for a specific program from the government, it's going to be called a deferred contribution or deferred grant contribution, and it'll be a liability, a debt, until you actually run the program and incur the expenses required by that grantor. Okay. This is significant because it actually is a debt, because the grant agreement essentially will state that if you don't spend it on that program, you can't spend it on anything else and you owe it back. And the same applies to a donor who says, I'm going to give you money to do this, for instance, buy laptops. So I was treasurer at the Brunswick Street Mission. We had a donor come in and said, and tell us, here's $40,000 to buy laptops. That's it. That's what you have to spend it on. We said, okay. But it's restricted to that, and it's owed back to that donor if we don't spend it on laptops, on the purpose defined by the grantor. And it's the board's responsibility for ensuring that these restrictions are known and respected. Okay. So, in the deferral method of accounting, restricted contributions remain restricted, okay, and called deferred contributions until the organization actually incurs the expenses to fulfill those restrictions. In other words, does the activities that are necessary to recognize the revenue, to recognize it as revenue, it remains a liability, a debt, until you do the activities that are required by that grant or that donation, that restricted contribution. And hence why it's called a restricted contribution. Okay. A deferred contribution, because a contribution, which is essentially another word for revenue for a nonprofit organization. Donations, grants can be contributions, but essentially a restricted contribution, okay, is one where you have to use it's restricted for that specific purpose, and it's deferred and called a deferred contribution because until you actually use it for that purpose, it's still a debt. It's not recognized as revenue. Okay. I'm going to speak about the language of the financial statements and what the terminology actually means. And I'm going to start with the definitions according to the CPA handbook, okay? Abridged definitions of them. But assets are considered economic resources, okay? Whereas liabilities are obligations of an entity arising from past transactions. So both of these arise from past transactions. So assets can include things such as cash, accounts that are owed to you called accounts receivables, prepaid expenses where you've paid in advance for a series of expenses that you haven't yet incurred, and I'll explain those in a moment, okay? They can also be capital assets, tangible or intangible assets. So capital assets is used as a term in privately owned businesses. So you're going to see that sometimes on nonprofit financial statements. But essentially, they're either tangible, which means you can touch them, or they're intangible, which means they're just defined by a contract, like a trademark as an example. Okay. So they're resources that you can use for the organization, whereas liabilities are debts and obligations. And for instance, deferred contributions that I just spoke about, where a donor restricts a contribution for a specific activity and you haven't done that activity yet, well, it's an obligation that you have to that donor or grantor. So they are obligations. Net assets is used instead of equity. Okay. So in a nonprofit, you'll see net assets. And what it is essentially is the residual. Take your assets, subtract your liabilities. So what you own and your resources, subtract your debts and your obligations. And what's left are your net assets. And essentially, these are created in large part by accumulating surpluses over the years. And surpluses, which means excesses of revenue over expenses, and you accumulate them over time. And I just want to highlight here that nonprofit does not mean that you're not allowed to have a surplus. In other words, that you're not allowed or supposed to have excesses of revenues over expenses. They're completely legitimate as long as there's a reason for it. Okay. So if you are accumulating surpluses, you need to be able to identify a purpose for those aligned with your organization's mission. And I'll show you some examples of these later on. We refer to these types of accumulated surpluses also as reserves. So the equity section of a nonprofit balance sheet has net assets instead of equity. And within it, the funds are sometimes referred to as reserves. And you're going to see that there are different types. Some are unrestricted reserves, which are just sort of like a contingency fund that you create. Some are restricted for specific purposes, and usually it's the board that establishes those purposes. Okay. Now, in a simpler language, you can consider these this way. The assets are the resources. that the organization has to achieve its purpose or its mission. The liabilities are debt owed to internal and external parties. Okay. Employee wages payable, for instance, are internal parties. Net assets are reserves that are or can be assigned specific uses. Okay. And they're created by accumulating surpluses of revenue over expenses. Okay. So we can rewrite the accounting equation in this format to say resources are the debts and your reserves. It's important to think about this for a moment, because what we're saying here is that the resources you have to achieve your mission come from two specific sources. One are debts, okay, and obligations owed to others, which can include deferred contributions from grantors. Okay. These are resources they've given you that you haven't used yet. Okay. But they're also a debt. And also your net assets, which are your reserves, the accumulation of of surpluses or excesses of revenue over expenses, what they call, or in for-profit statements, profit or net income. Okay. Accumulated over the years. So these are the two sources by which you finance the acquisition of resources to advance your mission. So if you want to, for instance, have a building to operate in, because your mission requires one, as an example, well, you're going to how are you going to fund that? You're going to fund it either through reserves by accumulating surpluses of income, of revenues over expenses, and or through debt, mortgages, as an example. Liquidity is a very big concern for a nonprofit organization because most of them fail because they lose liquidity. Okay. And what this means, what this means essentially is that it doesn't have enough cash to pay the bills that are coming due. And we use as a measure of this something called working capital. And on the balance sheet, we classify assets that are cash or can become cash in the next 12 months as current assets. So your accounts receivable, for instance, the amounts that are owed to you from other outside stakeholders, inventory, if you have inventory of supplies or inventory of groceries and so on, or if you are actually selling products, inventory of those, okay? These are, and short-term investments that are due in less than a year. You know, a term deposit, for instance, that has a 6-month window on it. These can become cash in the next 12 months. So we look at the current assets. All things current are cash or can become cash in the next 12 months. Current liabilities are the debts and obligations owed in the next 12 months. Okay. So the payables to your vendors, but also the current portion of any mortgage you might have or loan that you might have that's longer term. What portion of the payments, the principal, needs to be paid in the next 12 months? Those are the current portions of those obligations. The difference between these two is called working capital. And it has to be a positive number because what it means is that you have enough current assets, cash or things that become cash in the next 12 months, to pay for the obligations that are becoming due in the next 12 months. If the number is negative, you may have a liquidity problem. Okay. Well, you do have a liquidity problem, but you need to do something about it, in other words. Okay. Prepaid expenses are an unusual current asset because it's hard to imagine them becoming cash. And a good example of this is a prepaid insurance policy. You buy an insurance policy, you have to pay the whole year up front. But essentially, it's not consumed in a month. So if you have monthly financial statements, only a portion of that insurance policy has been used up, 1/12 of it, as an example. So we consider the portion that's not used up a prepaid expense. And it's considered a current asset because what it means is that it's not a draw on cash for the next 12 months because you've already paid it. Okay. So an example of this, of how it actually flows through, is a $1,200 insurance policy at the end of the first month. On the balance sheet or the statement of financial position, same thing. It's just two words for the same thing, two expressions for the same thing. At the end of the first month, there'll be $1,100 left. Whereas on the statement of operations, or what people often refer to as the income statement, you're going to see an expense for insurance of only $100 in the first month. This follows a principle called the matching principle in accounting. And why it's important is because we want to match the revenues earned in a period with the expenses earned in a period, so that we can see in a more level way what's happening month to month or quarter to quarter and year to year. Okay. If, for instance, we expense all the insurance in the first month, okay, in the second month, there'll be no insurance expense. And what that's going to create is, in the first month, probably a much lower surplus than should be there, or a deficit. And in the second month, it's going to create a surplus, which shouldn't be there because there's an insurance expense that hasn't been recognized. So we try to match things in the period that we're reporting on, what revenues and expenses align together for that period. Okay, I've already spoken about these, what they are. Okay. Capital assets, in other words, tangible assets. Okay. They can be touched. Now, the key to these types of assets is they're longer term. They have a lifespan greater than 1 year. So we would not include, for instance, in capital assets, things like office supplies. Okay. You go and you buy a monitor for a computer, you may include that, but you're going to want to ask yourself, do you want to incur the accounting cost for a $150 monitor by including that in your capital assets? Because capital assets depreciate, and you have to do accounting entries for that depreciation. In other words, we expense them over their life. So they last more than a year, we expense them over their life, and we have to do accounting entries for that every month or every quarter, depending on how often you report your financials to the board, or the board receives financials. Intangibles are those that are not touchable. Okay. So here's an example of depreciation. If you take a $20,000 vehicle with a 5-year estimated useful life, okay, don't know where you're going to get too many vehicles for 20,000 anymore. But essentially what this is saying is that every year you're going to recognize 1/5 of that. This is a simple straight line depreciation. So you're going to recognize $4,000 a year of the cost of that vehicle. You're not going to expense it all in the first year, because in the first, what that'll create is a deficit in your first year and then surpluses every year thereafter, even though you have a vehicle that you are using year after year after year for 5 years. So you're going to break it up over the 5 years and depreciate 1/5 every year. Okay. Now, I'm just going to show you a quick spreadsheet here of, if I buy that vehicle and I fund it with a grant, to show you how it actually flows through on the balance sheet. So we start off with a $20,000 vehicle, okay, on January 1 of 2021. I did this just to show 21 to 25. At the end of the first year, we recognize $4,000 of depreciation, okay? Essentially, each year we recognize 4,000 of depreciation, and it accumulates, and it reduces the book value of the vehicle year after year until after the 5th year, it's no longer appearing on the balance sheet. It's now 0 because it's been fully used up. Now, these are estimates, of course. We just use our best guess for estimating. It's not just a guess. We determine what its use is going to be, how much wear is going to occur, so that we try to do what the manufacturer will say about the vehicle. We try to determine how long the asset will last, and we depreciate it over that time. And it's never perfect. Okay, the estimates are just that, they're estimates. Okay, sometimes the vehicle dies beforehand or the asset dies beforehand, like a photocopier or a printer, sometimes it lasts beyond the 5 years. But this is how it would be represented on the balance sheet over 5 years using just a straight line depreciation. If there was a grant funding it for $20,000, you would also depreciate that grant. Amortize it is the word they're going to use. Amortization of deferred contribution. And you're going to amortize it over the same 5-year period, so that when you look at the income statement or the statement of operations, you see $4,000 every year claimed as an expense and $4,000 of grant revenue related to that vehicle, so that the net impact is zero. You receive the grant for $20,000 to fund a $20,000 vehicle. You're using it over 5 years, and you're recognizing the expense of that use over here, but you also recognize the grant over the same 5 years, over the life of the asset. So again, what you're doing here is matching period by period the revenue and the expenses related to this specific vehicle, the specific capital asset. Okay. The balance sheet just shows a declining value on the vehicle because the depreciation increases from year to year until the vehicle is completely used up. And it shows a declining value on the deferred contribution liability related to it from the grant. Okay. But the vehicle is not fully used up until 5 years, and therefore the grant doesn't get fully used up until 5 years has passed. Okay. So just to close on the balance sheet and the financial statements, I want to speak about net assets, okay? Because they are reserves that are created by accumulating surpluses year over the year in general, okay? And what's important is that you have to assign a purpose to these. Otherwise, you can lose your nonprofit or charitable status. There is a category you're going to see often on financial statements called net assets invested in capital assets. And that means those net assets are not available as reserves for your use because they have already been invested in purchasing resources, capital assets for the organization. Okay. So you can purchase, for instance, a vehicle with a grant or a donation, as the example I just showed before we took the break. Or you could use your net assets to purchase a vehicle. And if you use your net assets, it creates within your net assets what's called a restricted pool, restricted reserve called net assets invested in capital assets. And there are several types of funds that you're going to see on financial statements. And here are examples of some of them, okay? The board creates most of these, okay? And the board should be creating these and should be establishing the purpose for them. So I'll give you an example here out of Clean Nova Scotia's financial statements. This is the statement of financial position or the balance sheet for Clean Nova Scotia, okay, which is an environmental charity that I did work for a couple of years, okay. You're going to see here the current assets, an investment in an actual corporation, so a nonprofit can buy a private corporation and operate a private entity separately. An intangible asset or a trademark, capital assets here, and a note receivable. But if I go down to the net assets, you're just seeing a balance here, okay? But they're described further. Whoops. Oh, darn. Just have to rotate this here. So they have, for instance, an unrestricted pool, okay, which is basically completely used up in this year, which is sort of an undefined pool of capital. So this is one that you have to be cautious about, that you don't let it grow too large relative to the other ones, okay? Investment in capital assets is the net assets they use to buy their capital assets. Operating reserve fund, okay, which they define these different funds: building and capital asset fund, opportunity reserve fund. They've defined these three funds later on in the notes to the financial statements, but also restricted them by board motions to say this is its purpose. So the building and capital asset fund, its purpose is to finance the purchase of capital assets or renovations to the building. An opportunity reserve fund for them essentially is a fund that allows them to invest in a program before it is funded by the government, so that they have that pool of money there to get a project started without government funding. Okay. And the operating reserve fund is when they have to make changes to the organization, or they are expecting, for instance, significant wind downs of programs, and they need to have funds available to finance that. So they define it at the board level, but what's important is that they are defined. You can't just have, $5.3 million of unrestricted net assets. There has to be a purpose assigned to them. Otherwise, you can lose your status. Okay. All right. I'm going to jump ahead here to financial planning, where I'm going to talk a lot about budgeting. Okay. And essentially, it's an estimate of revenue and expenses expected in the future, is what an operating budget is. We generally define two types of budgets: an operating budget and a capital budget. Capital budgets are there to describe the capital assets we're going to be buying, and operating budgets are for the day-to-day operational activities and programs of the organization. Usually you create a budget before the end of a fiscal year for the next fiscal year, and it becomes the executive director's financial plan and spending guideline. And essentially, the budget should require the executive director to plan the activities of the organization for the next year. And that will inform how much is going to actually be spent. Okay. There's different approaches to budgeting, but it is important to try to have a sense of what is going to be the operational plan for the next year before you finalize your budget, and make sure that the budget you're creating will actually finance that operational plan. Okay. The approaches, they're zero-based, where you recreate a budget from scratch. And organizations that have significant changes in activities every year, in other words, they have new projects every year, they generally rely on zero-based. So Clean Nova Scotia Foundation, the majority of its budgeting is zero-based because it's new projects every year. Okay. They manage usually about 60 to 70 projects a year. And we call them programs, okay, often in the nonprofit sector, but projects, programs, it's all acceptable. Historical, where we look at last year's amounts and essentially adjust them for the upcoming year. So we look at what this year looks like, how it's ending, and we look at the history and say, let's use that as a basis for next year. Sometimes some organizations take averages of 2 or 3 years. I don't see that used as much anymore because there's been so many changes in the economic landscape and political landscape in the last few years that organizations don't tend to use averages of several years prior budgets anymore. They tend to do a forecast to look at how will this year end and use those numbers and last year's numbers as a basis to look at what next year will be. But those are for organizations that are fairly constant in operations and administration from year to year. And some organizations blend the two, where they have a portion of their budget dedicated to program or project funding and another one to their standard day-to-day operations and administration. Okay. What you want to look at when you're budgeting is the difference between what are fixed and variable costs. Fixed costs are easy to budget historically because they don't change much. Your rent, your insurance, as an example. Okay. Usually your power bills are adjusted by an annual increase factor, but there's not a huge differential in these things. But variable costs are different, and those depend upon the degree of activities that you have. And that's where, again, you're budgeting, for instance, for programs or projects, separately from looking at the history, where fixed costs, historically, you can usually get away with it. Variable costs, you have to look at the needs of the specific project or program. Okay. The thing to remember, and that is critical that the board understand when a budget is presented, is that when you're looking at future costs of new programs and activities that are variable in nature, in other words, they're subject to change, and they're subject to greater variability or change than your fixed costs. So when you examine a budget as a board, you want to highlight and discuss in depth those costs that are and revenues that are subject to a lot of variability because they are new or different. Okay. You're not going to be as focused on the rent, the insurance, the utilities. You're going to be focused on costs and revenues that are being created as a result of new programs or activities. What you want to try to do before you budget is forecast the current year end. You want to estimate what the current year will look like at the end of the year. Okay. And because you want to be able to use that information as part of your budgeting for next year, as one of the two historical years that you'll use, for instance, that year and the year before as an example, as a guideline. But also, it gives you a sense of what your cash position is going to look like at the end of the year. Because ultimately, your budget has to express a cash amount in the bank. You want your budget somehow to link back to what your cash is going to look like. Okay. Now, one thing that where you have significant changes from a budget from year to year, you want to sort of establish a policy, okay, of where does something need more explanations than other things need explanations? And you're going to extend that throughout the year as well, as we're going to talk about budgeting guidelines and reporting guidelines to the board. But you're going to want to sort of establish what the executive director has to do to explain differences and how much work has to go into explaining these differences. Minor differences shouldn't need to be explained. But you need to decide what do you think is a significant difference from year to year. Okay. Again, what's your approach to budgeting for the next year? If your organization has a high certainty of similar outcomes, use historical budgeting. If there's a lot of uncertainty, go with zero-based. Okay. Where are you going to get your data? Well, historically, you're going to use your historical amounts and your forecast for the current year. And then you're going to look at if you have any specific agreements in place or other sources of external data, such as collective agreements, if you have a union, rates of inflation, for instance, projected increases in power rates, the rental agreements, your lease might say how much your lease increases from year to year. For zero-based, again, you have to present every project, essentially. There are some different approaches to budgeting in terms of going bottom up or top down. Okay. Bottom up, all the projects all roll up into one operating budget and determine how the cash is going to be affected. So you first budget your projects and then your general operation and administrative costs, and then you put it all together. Top-down budgets, very often where you have a facility and you have to charge a membership fee, as an example, will start with all the facility costs at the top, and that'll become eventually a membership fee or a subscription price. Okay. So an example, when I look at the Clean Nova Scotia Foundation budgets, we took every program and budgeted it out for the following year, and then added it all up together to create a single operating and administrative budget. Started with the programs. We'd have shared program costs, and then we had administration costs for all of the programs put together. Okay. This is just one approach to this. It is not the only approach, and depending on the size of your organization, you may not have to do all of this. But if you are funded by project, which most organizations are now, there aren't many organizations that receive core funding. So they're funded by projects or by program. Well, it's best to budget the program for the upcoming year and determine what the activities of that program will be and roll up each one of those programs into a master budget. Okay. Whereas the top-down version, take, for instance, a facility like a pool or something of the sort, you're going to start with the costs of the facility and all of its service and maintenance related expenses, and that'll determine the fee you're going to charge. Okay. And an example I can give you of this, of that type of calculation, okay. No, sorry. It's coming up, actually. I actually built it into the slide and I almost forgot. Okay. So what do you want your budget to look like? Well, you're going to want the what your forecast is going to be to the end of the year, what last year's results were, what the budget for the upcoming year is going to look like. Okay. And the board's going to want to know explanations for significant differences. And again, you sort of have to define that. You have to say, we think this is significant, 10% difference from last year's budget as an example, or from the forecast as an example. Okay. If you go budget to budget, some organizations go do that. Most go budget to forecast. In other words, you forecast the end of the year and create a budget for the next year. Is the difference, 5% or greater or 10% or greater than the forecast? We want detailed explanations for that as an example. Here's an example of a very complete budget. And again, this is gold standard stuff, okay? If I look at this, this is essentially a statement from the Nova Scotia Barrister Society as it presents, as it's presented to the board every month, okay? The board receives this kind of financial statement: year-to-date budget, year-to-date actual, the actual versus the budgets, what the difference is. In other words, what percentage difference is that? And then the executive director has to explain significant percentage differences. What last year it looked like at this time, okay? The full year budget, the full year forecast, okay? And the difference between the full year forecast and the actuals. So this has a number of different columns that are being presented here. Not all organizations are going to do this, but this is sort of like a gold standard that I'm presenting here. What you want to see at a bare minimum when you're receiving financial reports, and this is where the budget kicks in, is a column for the budget, a column for the actuals and the difference. And if you are defining significance by a percentage, a column with the percentage difference. Okay. Some organizations say, anything over $1,000 is significant. Others say anything that's 5% different is significant. It's up to you as a board to determine what you consider to be significant. Okay. Oops. I jumped way ahead there. Okay. Here's some other examples, and these are good ones too, okay? This is Homebridge. Their year end, they show you exactly what's going on. They have the actual from this year, the budget for that year, and the actual from the previous year. This is in their actual financial statements that they present. And you can see, as a board, if I was looking at these, I would be asking myself some questions about some specific differences. Like, I wouldn't ask any questions about the grants because there's no difference, right? The per diems, I might ask, if they're expecting per diem revenue of 582 and they got 514, that looks like to me that it's significant. Amounts that were unbudgeted are always significant and should be explained. When I look at wages and benefits, I'm looking at a really big difference here of like 600 odd thousand dollars in the wages and benefits. I would want to know why. Okay. Food, probably easily explained by inflation, right? Homebridge operates centers for youth, for instance, right? Repairs and maintenance, they operate buildings. There must be an explanation for that, and it's probably quite rational and reason. It's probably a very reasonable explanation. But you're going to want to determine as a board which one of these differences, how much difference you want explained in detail. You don't want to have a rule that says any difference should be explained, because you're just going to create a pile of work for your executive director that's unnecessary. What you're going to want is significant differences explained, okay, to manage the workload for the ED. Okay. Municipality of East Hants has a beautiful piece to theirs, okay, and these are available, online. So if I look at the municipality, their budgets and their templates that they use for their budgets are all available online. So for recreation, for instance, they describe every new project that they're doing, okay, but this is the piece I like so much about it, and this is just a recreation department, okay? They do this. They go through their budget line by line, and they produce a report that says what has changed here by how much, okay? So what has caused increases in revenues or decreases in revenues, increases or decreases in expenses relative to the budgets? And they explain them. A one-line explanation is all that's usually necessary. And then at council, anyone that the councillors want to discuss in greater depth can be discussed in greater depth. But this at least gives, a line-by-line explanation of the differences. If you have time to do that, it's beautiful, right? Because it provides a great deal of transparency and diligence for the board. But if there isn't enough time to do this, just highlight the significant ones in a similar kind of report to show that you are fulfilling your fiduciary responsibility over the organization's finances. Okay. Now, some people will say don't budget depreciation. I don't agree with that. I suggest that it's important to budget depreciation. And the reason why is because you have to replace those assets. So remember the truck example, eventually it's worth zero and you're going to need to replace it. Have you created funds to replace that truck? Okay. So for instance, I'm just going to show this little difference here. Okay. 2020. I must have taken that from a really old template. So if I'm budgeting depreciation, okay, essentially I'm going to be likely showing in this scenario, all I want to show you is the difference that occurs as a result of budgeting depreciation. When I look at the cash impact, okay. Now, in this particular scenario, I've got amortization of deferred capital asset contributions, and I got depreciation. So both of these relate to a grant for an asset and depreciation related to that asset. If I include these in there, it creates a different perspective for the board than if I don't. The cash impact will be different because this is not cash and this is not cash. But I need to know this, okay, in terms of being able to match my budget to my operating statement every month for the board or every quarter. And I need to also know the cash impact because that'll determine what my cash position looks like at the start and the end of the fiscal year that I'm budgeting. And I will exclude from the cash impact depreciation and any amortization of deferred capital contributions because they don't affect cash. But here's what they do affect, okay? let's take a look at a top-down budget, okay? And let's look at what happens if I have to charge fees for services, fees for subscriptions, or if I'm determining how much I'm going to charge to sell a product, as an example. If I don't include depreciation, I'm going to charge less because it doesn't have a cash impact. But by including depreciation, I'm going to charge more. So this is if member fees for 500 members in this particular scenario. Okay. I'll charge more per membership fee. This is a good thing because what it means is that I'm going to be accumulating a pool of cash for the replacement of that asset that's being depreciated. If I don't create a pool of cash to replace the asset when it's worn out, I'm going to have to go into debt to replace it when it's worn out. If I need a vehicle to do for my program, I'm still going to need a vehicle in 5 years when the vehicle breaks down and is worn out. So I need to be able to create a pool of funds to replace that. So it's advisable to budget depreciation because that way you create the pool of replacement capital needed for that asset. Okay. You take it into consideration in setting your administrative fees, your membership fees or subscription costs, or your product margins. I just wanted to highlight that. You also need to do a capital budget, which is just a budget that lists all of the individual capital assets you're buying because it's going to affect your cash. Okay. What the board needs to know about a capital budget is the cost, including any delivery or insurance or installation fees for that capital asset, and how it's going to affect the statement of operations in the future. Like, how is the depreciation going to affect it? But will there also be, if it's a vehicle, any new costs that you should include in the budget for gas, maintenance, interest if there's a loan, insurance costs? If you're looking at computers and software that you've included as capital assets, maintenance and upgrade costs for the software, for the hardware itself, and if there's any savings or new revenues that can be generated from the asset. In other words, you want to say, how's it going to affect my expenses and revenue in the future? The fact that I'm adding this asset to my pool of resources for delivering my mission. The board needs to have a sense of what those costs are going to be, what those potential revenues will be. Okay. And it also the board also needs to know how it will advance the mission and how you're going to finance it. There are different ways of financing these internal net assets, accumulated surpluses, or bank loans, but there's also community bonds. You may want to look at Radstorm. They are an organization that's trying to buy a building here in Halifax. Okay, it's an arts and music-based organization, and they have issued community bonds, which are a way of raising funds primarily for buildings, because people buy these bonds and they need the security of the asset, which is usually real property like a building or land, right? And so far, they've raised, 179,500 of the funds that they need to raise using these community bonds to buy a new building. So it is a very legitimate source of funding, community bonds, okay? Lines of credit are only for short-term funding, okay? To make up for the time that you haven't yet received your grant funding, so the delays in grant funding or in other receivables, that's what lines of credits are for. Blended payment loans for purchasing vehicles or other capital assets or buildings like mortgage loans, they're for longer term financing, and they're usually related to financing a specific asset. Okay. But community bonds, as I said here, is definitely something to look at when you're looking at buildings and land. Okay. When applying for funding, again, we're looking at most funding now being project or program based and not much core funding available. Try to charge an administration fee if it's allowed. Okay. Usually 5 to 15% is considered reasonable. When you're applying in a grant application for a specific program, as an example, try to convert your overhead costs into program costs. So take reasonable portions of the cost of time spent by the executive director and management and the accounting staff and so on for actually processing or overseeing the program. Set an hourly rate that's reasonable and market-based, okay? Or if they want actuals, based upon the actuals amounts that are being paid. But always include enough for your fringe costs for CPP, EI, pension, and insurance if you have those, okay? Charge vehicle use by the kilometer, but always give it by hour, okay? In a grant application, most grantors and funders like to see the specific number of hours that'll be spent by management or accounting staff for a specific program. If you have vehicle use charged by the kilometer, use the federal government rate guidelines, are about 70 cents a kilometer. Charge rent and utilities for space occupied by program staff. Use the square footage to allocate these costs, okay? And if you own a building, consider establishing a second organization that leases the building and furnishings to the operating organization. Charge rent to the programs. We did this with the Acadian Federation. We created a separate organization called the Société Maison Acadienne, which owns the building and all of the furnishings and computer hardware and so on that is used by the Acadian Federation. Because the grantor would not allow us to expense building costs. But if we were paying rent, they said, yeah. So we created a separate organization, put the building and everything in there, same board of directors, okay, just a separate organization, and that organization charges rent, and the rent is eligible for the grants. So these are federal government grants, and so these are just some of the conditions that are attached to those grants. But these are ways of applying for funding where you can actually expense some of the things some of your overhead and fixed costs. Internal controls are just procedures used to find errors and protect your assets. Sometimes they're hard to implement because people think that you're implementing a system to watch over them because you don't trust them. But that really isn't what it's for. Primarily, it's to catch errors and make sure that what's actually going into the financial records is accurate. But it's also there to just protect the assets. Password protection as an example, right? It can capture fraud, but remember, it'll only capture fraud if there's no collusion. If two employees are colluding together, it's very difficult to find fraud, okay? The most important control is the bank reconciliation. And that should be performed by somebody who is not signing checks. And what it is essentially you match up the bank statement to what's in your general ledger account for the bank, and you describe what makes it different. Why is the amount on the bank statement on March 31 different than the amount on the balance sheet for cash and bank from the general ledger? Why are these two numbers different? And they will always be different. I don't think I've ever seen a bank reconciliation where the statement balance and the financial statement balance, bank statement balance and financial statement balance were identical. But the bank reconciliation explains those differences. Are there delays, for instance, because the check hasn't been cashed, but it's been recorded? Okay. Are there charges that the bank has charged that hasn't been recorded in your system yet? The bank reconciliation identifies those so that you can capture them. It's also it's important that it's reviewed by someone who has nothing to do with the bank account. Okay, someone on the board should review this. They should have a bank reconciliation report provided by the software and the bank statement, and they should be able to compare them. And they should have the canceled checks if you have checks available there for them to review as well. When I took over as a director of finance for one charity, the bank reconciliations were not functioning properly. I looked into it and found $78,000 of theft by the previous finance director. So it's an important control, not just for fraud, okay, but for capturing errors. And that's where you're going to see things like, is there a check that's been paid to, or a direct deposit payment to the Canada Revenue Agency for source deductions in that month? So they're very important. And payment cards should be reconciled as well if you have visas, as an example. Treat them like bank accounts in your accounting system and have a reconciliation for them and have them reviewed again by someone who is not related to their use. Basic payment controls have at least 2 signatories for each check, and at least one of them should be from the board. Don't use electronic payments until you're large enough to afford a dual signature electronic payment system, okay, like RBC Express. Don't sign checks without reviewing the related payment information. So checks should be presented to a board member with the supporting documentation attached to the check so the board member can clearly see that it's a legitimate purchase and that there's no error in the amount being paid. Okay. If you're an HST collector, oh, I forgot the letter C there. Okay. It's important that someone on the board, review the most recent HST remittance statement. Okay. And also that this is included in the minutes to the board. Okay, that review has taken place and that there are no amounts owing. Include those in the minutes because that's part of that due diligence defense. Okay. For payroll, if you can use an outside payroll company, use it. Lots of them are very affordable and cheap. I know some small charities that use them that have very small income amounts. They are not that expensive, but they take care of your records of employment, your T4s, and all of your payroll remittances for you, and they provide you a statement that you can present to the board that shows that everything's been properly remitted. Okay. A board member should review the payroll register. Okay. And if you're not using an external provider, then the executive director or the treasurer should include a copy of a statement called the PD7A that shows that last month's remittances were made to the Canada Revenue Agency, and include that review of that in the minutes of the board, again, to protect the directors. For deposits, issue number receipts for any cash donation. Just a simple receipt book that has a set of numbers on them, okay, the numbered receipts. They can be written by hand. This isn't a tax receipt like for a charity tax receipt. It's just evidence that you received money, okay? That way you can match it up against the deposits and make sure that the money that was received was actually deposited in the bank. And don't accumulate large sums of cash at the office. Deposit regularly. Now, finally, we're coming to the end. Review engagements and audits. Review engagements are less costly than audits, all the accountant does in that situation is certify that the statements were prepared in accordance with generally accepted accounting principles. Most grantors accept these. Audits are costly because what's happening is that the auditor is certifying the statements are materially accurate. And materiality for nonprofits often in a range of about 3% of revenue or expenditures. So if you think about this, an organization that has, $1 million of expenses, well, 1% of $1 million is actually $30,000, or 3% of $1 million is $30,000. The statements can be out by $30,000 and still be materially accurate and pass audit. And I bring this up just so that you're aware of this, that the auditor is working within a materiality limit. They're not guaranteeing that the statement is absolutely precise, but that it is materially accurate within about 2 to 3% of your expenditures. And you should ask the auditor the board should ask the auditor, what is your materiality limit here? And he'll give you the number. Okay. The advantage of the audit is that you're going to get an internal control management letter with the audit, which defines the deficiencies in your internal control procedures as an organization. Every board meeting have an operating and capital budget review. Make sure the operating budget lines up against the actuals for the period and discuss any significant variances. And that the capital budget, that you follow that one as well. It might only have 2 items on it, a truck and a computer, as an example, okay, or a desk and a computer. But make sure that it's discussed at the board so that you know that it's actually being done. Okay. Write a policy that sets the budget as a spending guideline for the executive director and the organization as a whole. This way, your executive director doesn't have to go back to the board for every expenditure. As long as it's within budget, the executive director has the authority to spend. In the policy, set a limit on what you consider significant, as I mentioned already, and that the executive director should be responsible for explaining every significant difference. And you can also set a cap. For instance, you can have an emergency cap on an operating budget of, for instance, $5,000, where the executive director can go spend on something that was not budgeted at all up to that amount. Roof caves in, right? If you operate a facility, including the emergency capital fund for emergency repairs that the executive director can use without permission. Finally, investing guidelines. Get advice from your bank or your investment advisor, but determine the risk tolerance of the board, okay? And determine when you're going to need the funds before choosing your investment. Remember, term deposits and guaranteed investment certificates are very low risk, but very low return. And essentially, you shouldn't have more than $100,000 of term deposits with any one institution because that's the CDIC coverage limit, okay? So if you have 300,000 of savings, split it up between three different banks, or get a RBC Dominion as an example, or CIBC Investor Services to find you 3 term deposits from 3 different trust companies or banks. Select the duration based upon the cash requirements. But if you can tolerate some variability in your long-term savings, use mutual funds, which are essentially pools of money that are managed by a professional manager. Pick the ones that have the lowest management expense ratio because the expense ratio is charged whether or not there's a profit or a loss in the fund. So it magnifies losses. So pick the ones that have the lowest expense ratio. If you receive donated securities, which are very popular with charities because the donors avoid capital gains tax by donating their securities to a charity, check with your bank or investment advisor if they should be cash because people often donate them when they're at a high, so that they're donating them because they don't want to cash them at that point because essentially they would incur significant capital gains tax liability, but while they're at a high, they get a donation tax receipt for the full fair market value, even though they don't pay any tax on all the growth on their shares during the life that they've owned them. Okay, so you want to ask your investment advisor if you want to cash them or hang on to them. Okay, because they may be at a high when you receive them. It may be ideal to cash them at that point. Okay, sorry I was going so quickly there. Are there any questions?